we have the battery metals panel. So I'd like to invite up to the stage Harry Fisher, Project Manager for Consultancy at Benchmark Mineral Intelligence, Laura Hubbard, Managing Consultant for APAC at Wood Mackenzie, Alberto Migliucci, Founder and CEO at Petra Commodities, Paola Rojas, CEO at Synergy Resource Capital, and Keith Muller, Chief Executive Officer at Atlantic Lithium. Thank you for joining us here this morning. So to just kick things off, can you just give a quick 1-2 minute introduction to yourself? So starting with Harry.
Morning, everyone. My name is Harry Fisher. I'm from Benchmark Mineral Intelligence, primarily focusing on our consultancy services and any advisory service within the lithium-ion battery supply chain. My specialization is generally within nickel and cobalt, so I'll probably end up talking about that a lot today. If you've got any questions on lithium, then my colleague Cameron Perks is here today as well.
Thank you, Amy. Alberto Migliucci. I'm the founder and CEO of Petra Commodities. It's a Singapore, Sydney-based boutique sort of investment bank firm. I'm a geologist by training, but then went into investment banking. I used to be head of Credit Suisse for mining, energy and oil and gas for Asia. And what we do is we look at opportunities, we raise capital, we have access to family offices and high net worths around Asia Pacific. And events like this are important to me because one-to-one bring 20, 30 companies under one roof, and I get to sort of scan and see which ones we want to invest in. And it also gives you a feel of what's happening in the market. So I can walk through the aisles here and I kind of sense what the buzz is. So pleasure to be here, and hopefully you find this interesting conversation.
Hi, everybody. I'm Laura Hubbard from Wood Mackenzie. Wood Mackenzie predominantly is a research organisation looking at the oil and gas sector, mining and commodities, and now looking to help inform our clients about the energy transition. We also have a consulting division, of which I'm part. And I look at battery raw materials and the battery and EV supply chain, helping clients on financing and strategy to get the most value out of the assets.
Hello, everybody. I'm Paola Rojas. My firm is Synergy Resource Capital. We are a corporate advisory and investor in natural resources and technology. We have had a focus on the energy transition before it was called that. So that it feels good to have that sort of a mainstream theme now. And we help companies find assets and get into specific jurisdictions. And we also help raise capital and do some investor relations as well.
Good morning, everyone, and welcome to those viewers joining us online via the socials. My name is Keith Muller. I'm the Chief Executive Officer of Atlantic Lithium. We're in the process of developing a hard rock spodumene asset in West Africa, in Ghana specifically. I think what I'm going to bring to the discussion today is perhaps the lens of an operator and what we're seeing on the rock phase of how we bring new projects into development and how you run those assets successfully.
All right, great. So as with previous panels, I want to keep it quite conversational and open to discussion. So if anyone in the audience at any point during the session has any questions, just feel free to put your hand up and we'll get a microphone over to you. So I thought we could really kick things off with kind of looking at the broader issues in the market, which is really kind of this looming metal shortage. So where do our panelists see some of the biggest deficits in supply in the coming years? What are the risks that are going to come with that, and potential solutions? So anyone who wants to start? Paola?
I think the main bottleneck that we see ahead is obviously, and that was kind of a tease, what I said before, is all the metals that are supporting the energy transition are going to be, or most of them are going to be in a very strained situation. Between all of them, I think what we worry the most, not because it's so close to today, probably. But in the sort of years ahead is copper, because I have to give you a little bit of a background. So my father was a geologist. He was a porphyry copper expert, and he used to manage BHP for Argentina for BHP. And in the early 90s, they were exploring and talking about copper all the time. That decade was so significant for the metal. Like, so many large mines were found and put into production. And many big deposits were identified, but sort of stayed in sort of development phase. And over the last couple of decades after that, that changed. The investment fell, and turning these deposits into actual mines kind of changed and sort of stopped. So if you look at the timeline, it looks pretty empty today. So in my view, I think copper and lithium are my biggest spaces, but I think copper, we're not yet ready to see the impact because of that lack of investment. It's changing, it's slowly starting to change, but I think it's a bigger problem because it's a bigger sector. It's already, the third largest metal market. So that would be my idea.
Anyone else that wants to just jump in?
Yeah, so at Wood Mackenzie, obviously we're looking at the energy transition and the incredible requirement of battery raw materials required. We're forecasting that 50 million passenger plug-in EVs will be purchased per year by 2040, which will be 45% of new vehicles. So that will require all of the battery raw materials that we've been looking at. I think obviously last year there was an incredible increase in price for these materials and a great sense of shortage and opportunity. We're now moving into a period of oversupply because new projects have coming online. And so I think there is a danger that that sentiment could cause sort of a shift away from focus on this area, and that could mean that the forecast sort of deficit we're expecting in all these key materials could be exacerbated. We're forecasting that by 28-30 we will move back into deficit. So I think it's very important to continue this focus. The demand will be there, and not let that sort of decline in the price stop us from continuing to develop these much needed projects.
Yeah, I'd probably just second that, actually. We've consistently said at Benchmark that the raw materials is really the bottleneck for the supply chain. It takes 7-10 plus years to develop these mining assets, as we know, whereas the downstream can be developed much more quickly. We've had a lot of talk about what's happening in the mid and the downstream, or particularly gigafactories in the downstream, but the commitments for raw materials aren't always there. We're oversupplied at the moment, but we've seen in commodity markets in the past that's a dangerous game to play, because we see going back to copper, capital in copper all the time, we see a lack of investment, and then suddenly there's a big crunch. And the danger that starts to happen as well for battery raw materials towards the end of the decade. And for nickel and cobalt, they're both in kind of fairly significant surplus at the moment, but the demand outlook's very strong. So it won't take long in relative terms to swing back into a more balanced and potentially deficit market, and that obviously means that the prices will respond. But it's always the balance of that investment versus the commodity cycle.
I can add to that. So you just have to listen to what Laura and Harry said in terms of those supply deficits. And the arithmetic reality is that global population growth, economic growth, and then the increase in standards of living of some less developed nations are just going to put incredible pressure on the amount of energy we need going forward. So just that as a base level just means we're going to have an incredible amount of energy, even if we didn't have this whole EV paradigm, renewables. So that would put a lot of pressure on existing energy sources, which are fossil fuels. So the complexity about all this, and I don't think many people really appreciate how difficult and massive this task is in the last 200 years, humans have actually pretty much used one main energy source, and that was fossil fuels. So back in 1850, 7% of the world's energy was coal, and 93% of the world's energy came from horses and labour. So it was, the old elbow grease and horses. And so it was only 7% of the energy source was coal. And we moved on in the next century and a half. So in 150 years, everything we know has come from fossil fuels, pretty much everything. And now we're trying to turn that upside down. So that's a massive task. And you'll hear numbers from Benchmark and Woodmac that we need, an extra 50 lithium mines by 2030 and all that. So the numbers are just mind-boggling. So you can just throw a dart at which commodity you think will win, but I think they will all win, and it won't be linear. There's a lot of the world's trying to find out where the equilibrium is on balance of energy. And I remember giving a presentation 15 years ago as the head of oil and gas for Credit Suisse. Everyone was asking where the energy balance is, and I was always saying, well, it's going to be LNG, coal, oil, and there was always a bit of hydro there. And now that conversation is come to the front with what is it now? And when we talk about lithium, lithium's interesting because lithium is very smart. They're the marketing guy because everyone says lithium-ion batteries. But a lot of the batteries depends on which configuration. They probably need nickel or manganese or cobalt. So lithium got the marketing rights and they did well. But it's not just lithium. There's another half a dozen metals. And if we include the previous presenter on uranium, and you've got hydrogen, and then you've got recycling of existing metals. So they're all going to come into play. So I think the key is that the scary thing is that 200 years of technological advancement, everything we do, whether it's medicine, making your daily bread, energy has come from fossil fuels, plastics, petrochemicals, and now we're trying to turn that all over. So that's going to have an increasing squeeze in the environment, but also capital and financing, which we'll discuss later.
Thanks. Maybe if I can add to what Alberto is saying about the different battery chemistries. So one of the important things to consider is what the application of the storage is, whether it's going to be mobile or whether it's stationary storage. And a lot of movement is working towards stationary storage, moving away from lithium due to the current supply constraints, so redox, vanadium batteries and the likes. But certainly when it comes to battery chemistry, one of the things that don't change is the periodic table. So whether you go to NMC batteries or you go to LFP batteries, lithium is a common commodity in all of those. So I do think lithium is going to have a pinch for much longer than we expect. We seem to be finding substituted chemistries for other types of batteries, so with the rise of LFP being more suitable for perhaps your general commuter and the high energy, high density NMC batteries. So I think we've got to answer both the questions of what the application is as well as the battery chemistry that's suitable for what the requirements are of the end user.
Just on battery chemistry, I think the benefit that lithium has is that the intensity doesn't vary a huge amount chemistry on chemistry of the major ones we're seeing at the moment, whereas nickel and cobalt, you see big swings in intensity between those chemistries, and that's why the LFP NMC argument's probably never going to go away. We'll probably be talking about it on these panels for years to come, but that's always the benefit for lithium is it's got the strongest demand outlook of kind of the major raw materials, and probably has got less downside risk than particularly nickel and cobalt. But we're certainly seeing that there's place in the market for kind of both of those major groups. For the electric vehicle market, there's going to be big differences between North America and Europe versus China and Asia. and that will mean that we see different trends in different parts of the market. But overall, we're seeing kind of a fairly even split in the long term between those nickel and cobalt chemistries and LFP. But there's obviously been a lot of strength in LFP, and particularly in China in the last couple of years.
How do those changing technologies impact potential investment decisions? So at some of our previous events, we're talking about this technological risk where not knowing which metals will be kind of those key battery metals moving forward. So how do people position themselves with this technological risk overhang? Maybe it's a question for our investors.
Well, bankers traditionally hate to take risk. They like to take everyone else's risk, but not theirs. So there'll be any new technology, they'd be a bit hesitant in funding. But I think we safely say that, like Harry mentioned, I mean, lithium's been around now for a while, at least a decade, where bankers have got more used to understanding that technological risk. Interesting, also geological risk, because so I've been in the industry for probably plus 30 years. And, if you said to me 10 years ago that someone was a lithium geologist, I'd say, what? I didn't even know such a thing existed. But you see now all of a sudden everyone's a lithium expert, and that ameliorates the risk where people begin to understand the geology, and there's different types of lithium, obviously brines and spodumene and all that. So there's always that debate, and I'm sure many of the people on this panel can comment on those risks. So bankers have to take a risk on that. But the good thing is this has created a platform where I actually think, well, I definitely know that if you go to pretty much any banker in the world and say, would you want to finance this established high quality coal mine or a brine out somewhere in Latin America, which is still sort of in early stage development, fortunately, unfortunately, you know where that answer is going. And it's a harsh reality. I can't understand that sometimes from a finance or investment perspective, but that's where business is. These days, it's actually better off having a small cap lithium company explorer developer than an established, mature coal producer. So it goes back to finances and investors are comfortable now with lithium risk and cobalt risk. The problems now become not so much the commodity, but the jurisdiction. So, the guys on either side of me here will know the numbers exactly, but like 60% or 70% of the world's cobalt comes from the DRC in Central Africa. So there's always a bit of political risk associated with that. Some places in Latin America are a bit riskier than others in terms of where the lithium comes from. So there's an overlay of financing. There's a technical risk, but then there's a geopolitical risk on top of that.
I think that's a really good point, and I think we are starting to see more diversification for that reason. I think that some markets have been heavily leveraged on single or couple of countries. Cobalt, for example, mined in the DRC, processed in China. But we are seeing fairly rapid diversification in nickel. Indonesia didn't really exist as a nickel market 10 years ago. We have, I think, around in 2015, we've got about 5% of nickel production was coming out of Indonesia. Now it's about 50%. So in 8 years, it's risen to a global force, and that's just going to keep going. Obviously, in lithium, we've got a lot of development happening in Africa at the moment. It's still small at the moment, but that will start to change. I'm sure we'll come on to it later on, but the policy drivers such as the Inflation Reduction Act are having an impact there too as the supply chains start to shift. Already we're seeing a lot of movement that in the downstream, but even in the upstream now or the midstream, we've got in the last few weeks there's been a couple of big investments in Morocco. We've got a lot of movement in South Korea or in South Korean companies investing in various jurisdictions. So yeah, I think it's a really good point, and that trend is likely to continue.
I think the other thing that we're going to be seeing a lot is more M&A, but not only in the sort of more traditional sense, but in kind of creative ways, which we have started to see a lot this year. If you compare, especially in the lithium space, if you compare the copper sort of universe, you see that there's a very diverse group. So you have your larger, the majors, you have a big group of mid-tiers, and then you have the smaller players. In lithium, that it exists, but it's so much smaller than for large players, which are not that many, to grow. The only way that they can grow in a significant way is by buying a near development asset. And we're seeing an example of that just happen, not happen in reality here with Albemarle trying to buy Liontown, and our Gina Reinhardt, she just decided, okay, this is not happening, so I'm going to start buying, and that's finished. So, but if you look at the asset and at that trend, so the company still had a big, change in their shareholding. So it's still a deal, even though it's not a deal like the one we or many expected after the Albemarle bid. So I think we're going to see a lot of that, and we're going to see a lot of deals between more automakers and mining companies, and we started seeing a lot of that. Yeah, of course, we saw offtakes. That was sort of traditional, but and very much needed by the lithium players. But now we're also seeing the sort of more entangled, and not in a bad way, more intertwining these different parts of the battery supply chain in a like the deal by GM by investing $650 million at the asset level in Lithium Americas. That triggered a sort of a facilitation, if you want to call it that, or it eased the road for that asset to get final permits and finally start construction, the Thacker Pass project in the US, and the split of this company into two different assets. So I think we're going to see a lot of those deals. So the M&A is going to keep, we're already seeing a lot this year. It probably is going to be a record year, I even think.
To the specific question about the risk profile associated with different battery chemistries, I think one important thing to recognize is it depends on where you sit in the value chain. So if you're sitting right at the tail end of a cell manufacturer or a precursor or a converter that produces hydroxide or a carbonate, you sit on your feedstock. You've designed a plant $500 million to $1 billion of a processing facility to take a certain set of feedstock characteristics and specifications. So perhaps the lower down you go on that value chain, you're less exposed to the technology risk. So as a producer of spodumene, our risk profile to battery chemistry is probably less than that of a converter or a precursor material producer. So for us, it's about putting molecules into the market. And we see this tendency of a lot of producers now looking at vertical integration of their supply chain. There comes a risk with that because you set on a pathway that you can't undo. Once you've established those downstream processing facilities, you are now set and you're locked into the particular chemistry that you bet on. So for us, we like to be on the lower risk profile of that. And that's also where the margins are sitting at the moment. I think longer term, we're going to see margins return back to the converters, but at the moment, it's sitting in the hard rock assets.
Do we have any questions for the panelists before we continue on? Yeah, we'll get a microphone over to you.
Two questions. So you just did mention, from a future, potentially from an ESG point of view, with DLE, we're all talking about DLE a lot, and whether that's really going to drive the proposition to be more brine orientated. How does that really affect the future prospects of all of the hard rock projects, in Australia? That's one part. And the second one is, haven't really mentioned anything about spherical graphite yet. Maybe if you could have a bit of a commentary on there, and whether you think synthetic So where the synthetic part fits, I mean, there's like, there's energy costs that feed into the synthetic side of things. So depending on oil prices, how that feeds into that, whether you feel that synthetic versus natural spherical graphite, what your feeling is there.
I can speak to your question on lithium brines versus hard rock. I can't comment on the graphite. Maybe one of the other panelists would like to take up that challenge. But in terms of the molecules to the market, you're absolutely right. From an ESG perspective, there tends to be consensus that brines tends to have a lower carbon footprint than hard rock spodumene mining. But then again, we look at lepidolite, low-grade lepidolites in China. That's got an enormous carbon footprint compared to even the best spodumene producers. But then DLE also has a very high energy intensity, and that energy is not for free. Unlike evaporation ponds where Mother Nature is providing energy free of charge for you, just takes time. DLE does have that larger input of energy consumption. But then again, you look at the uranium story, and that's perhaps where you can combine new energy sources with storage capability. So maybe anyone wants to tackle the graphite question about spherical and natural versus synthetic?
Yeah, just a couple of additional comments on the DLE. I've been looking at this lately, and we're seeing around a third of lithium units coming from brine going forward and remaining sort of at that level. And DLE has become a bigger part of that picture with so many operations in China using DLE now quite successfully. They've sort of implemented those, which has, I guess, given us confidence that this technology can be commercialized. I think the thing is that in China, in Shanghai and in Tibet, you've got this lower grade lithium than you see in South American brines, and this high level of magnesium, which necessitates this different way of extracting that lithium. In Tibet, you've also got a very cold environment, these long winters that make it difficult to get the high quality lithium product out of that brine. Unlike in Latin America, where you've got better solar evaporation from a higher grade brine to begin with. So while I think over time we will have the DLE technologies commercialized that could be implemented, it'll kind of be a cost-benefit analysis of whether that makes sense or the low carbon option that we already have available to us is the best option going forward. And of course, you need to tailor the DLE system to the individual deposit. So it's not, we won't see kind of a sweep through of everything based off the same process. So I think there's opportunity there, but I don't expect to see it revolutionize the whole industry. And then spherical graphite. It is something that we talk about less. It's sort of a lower value input and sort of impacts the cells less from a cost perspective. Obviously, spherical graphite can be very high quality, can make for a very well-functioning battery and can be produced at very low cost at the moment. So I think that can be hard to compete with, but you do have a carbon footprint and also a kind of a sourcing diversification issue with spherical, which does keep natural graphite in play.
We have another question, yeah?
Firstly, thanks for your commentary today. It's been good. I was here last year and I came away very bullish about, battery materials and thought this looked like a really good space. And in fact, I was on one of the panels, right? So I'll wear some of this as well. And I look back now and I go, well, lithium down 50%, copper down 15 or 20%, cobalt and nickel down substantially. And I'll note that I think Harry gave a talk on nickel and cobalt last year and actually called it pretty well, right? So well done to Harry. But I guess the question is, given the macro where energy transition is happening, demand is increasing, supply is constrained, you wouldn't have really expected what happened over the last year to happen, and it probably just highlights the difficulty in forecasting and predicting. So I'll just be interested in your thoughts on what makes it so damn hard.
I've been having this thought that we should rename forecasts as guesstimates. Because in reality, no one really knows. And, you may say, oh, my feeling is I'm bullish copper, so I think copper long-term is going to be a good bet. And I'm pretty confident that that's going to be the case, for instance. Now, is it going to be next year? Probably not. Is it going to be 5 years from now? More likely. But then you start playing with probabilities and, it all starts becoming really difficult. I think what we can do, and I think probably for investors that want to play in this space, it's really important to have a long-term view. It's hard to be a trader in this space, and I'm not saying that's wrong. Like some people, just come in for a day or a week, and they get out because they see a very specific opportunity. But I think in this space, you need to sort of form a view of the long term and play it in that role and in that sort of mindset. And you have to kind of be a little bit sort of not get too anxious with the swings, because there's going to be swings. This is commodities are bought and sold, and demand, supply, it's going to move, and we know it's going to be that. So that's the way I look at it. So think of the long-term view. Are we going to need, in a decade from now, are we going to need more of this or less? Well, we're gonna need more. Okay, let's play the long game. That's the only thing that I can say to that.
Yeah, I agree. I feel like I'm going to give you life advice rather than investment advice now. But we can have a drink after this, and you should cheer up. No, it's funny because you reminded me of when I used to present a decade ago on various commodities. I'd put up the forecast of what Goldman Sachs thought, say, the gold price or coal price or iron ore price would be. And I'd put ANZ's price and JP Morgan and Credit Suisse's. And then I'd revisit it the next year at a conference. And every single one of them, usually without doubt, were wrong. But like a massive factor. It wasn't even wrong by $1. They'd be wrong directional-wise. And I used to put this up and say, see, this is how difficult our industry is. It's so cyclical. So you're just proving that point. But I think what Paola said is the key. Our industry is a long-term. It can take 10 years to build a mine, get it in production. So I typically don't look at day-to-day prices, but I have to take a long-term forecast of where I think that price will be. So that's where and typically bankers take a very conservative approach, a baseline. But look, I think generally the industry is still buoyant. There's a lot of, like I said, I'd rather be a lithium company now than some of the other metals around. If this whole EV paradigm didn't happen in the last decade, I'm not sure where mining would be now, because outside the cobalts and the nickels and the coppers, there's very little going on. I mean, gold's always big, but apart from that, there's very little going on. And my colleagues to the left and right of me probably wouldn't be that sexy in terms of what they're talking about. As in, I mean, iron ore, that's always good, but that's quite predictable in where that's going. So yeah, but it is, I think this conference, it should be buoyant because the industry is buoyant, and everyone, even your taxi driver and your hairdresser, will know what lithium's about, right? They all talk about this. So it's pretty much pervasive, right? I mean, I go to primary school children now know what lithium about, but I don't think 20, 50 years ago, if primary school children were that aware of what commodities went into their phones or, rare earths, example. So we'll have a drink later.
I think it's also easy to forget that we're in kind of quite an emerging market. Like we talk about this market as if it's vast, and it's really only started. I'll show in my slides after this. I always like to show kind of where we are and where we're going, and we're just about to hit a terawatt hour of battery demand this year, maybe early next year. But we see that going to 8 terawatt hours by 2040. So we're really only on that first uptick, and we've only really seen the big first wave of EV demand in 2020. COVID, in a way, kind of did a bit of a favor to a lot of countries because it gave everyone a bit of a shove, saying, well, we need to kind of get this going to get the economies back going. So I think it's easy to forget that we've really only at the start of this big thematic in commodity markets. And yeah, I think the long-term sentiment is important, and our methodology at Benchmark for price forecasting considers that. So we've got kind of a short, medium, long-term view. The short term is always rocky. It's always volatile. I think we never get it right. But I think kind of comparing last year to this year, what nobody really saw coming was this slowdown in China, in battery demand globally, pressure on EV markets, continued pressure on the portables market, which is still a fairly significant part of the battery market. It doesn't really get much talk about. It's not very sexy, but it's had a big impact on cobalt in particular because cobalt's key in the LCO chemistries going into mobile phones, laptops. So I don't think anyone really saw that coming, but at the same time, we've had continued supply additions, some of which have gone ahead of where the market expected, particularly for cobalt, and particularly for nickel as well. So it's not been a great period, but I think it's important to remember that we'll move through that. And actually, our long-term view hasn't changed vastly in that period, despite all the volatility. Yes, there's been supply additions, which may move when the market goes back into deficit a year or two here and there. But overall, Benchmark's view is that the long-term outlook is very strong, but we need the raw material investment to ensure that we can get to that endpoint.
Yeah, I think just following on from Harry, I have to toot Wood Mackenzie's horn a little bit here that we did forecast this supply growth and the decline in battery raw material prices this year. We saw that new supply coming online and knew that things would go down to a more sensible level from the sort of sentiment-created bubble a little bit last year. But as Harry said, it's a very difficult set of markets to predict. One of the things is a market growing at the rate that we're seeing is just whether it's 10% or 20% growth. It's difficult to get that exactly right, and we see the suppliers having that challenge of when do you bring on new supply. And so particularly in the lithium market that's coming off such a tiny base, you see these bumps of kind of supply coming on earlier than it's needed or later than it's needed, and that causes a huge amount of volatility, which is challenging, but obviously that long-term outlook will eventuate through that volatility.
I think if I can add to that as well, you mentioned the coming off a small base, a single destocking event in China, and you see the bottom fall out of the market. We just went through Golden Week, and I won't be told the Chinese don't conspire on pricing and feed misinformation into the market. So coming from such a small base, the volatility is huge. You mentioned that the prices came off 50% year to date. 3 years ago, I was selling spodumene concentrate for $320 a ton, and we were making money. I think spot price this morning was $2,500 a ton. So I would love to be in this situation 3 years ago. So even though the prices has come off from a very unrealistic high, that's not a sustainable price. $8,000 for spodumene concentrate, no one's making money at that prices except for the miners. But that's not a sustainable environment. So I think the price coming off is actually healthy for the market. One of the things, the dynamics I think we're finding ourselves in is supply is going to drive more supply. If the prices are $8,000 a ton, converters can't afford those pricing, but prices at a sensible level is actually going to feed more into the supply, and then demand will increase proportionally.
Okay, so I thought we could talk a little bit about kind of the impact of the government regulations. How is it impacting where the money is going right now? So things like the IRA and in Europe and Canada as well. So
I think one of the crucial elements for this energy transition, and that gets talked about a lot, is specifically what's the role of governments and how can they help get the sector to, or not the sector, but get the supply that we'll need so that we can actually eventually, decarbonize. The IRA has had a very significant role, and he has onshored a lot of not only investment locally and partnerships and a lot of activity, but I think it's also acted as sort of public perception change for more people to actually, in the US, to actually, realize that this is something that they need to consider, that's happening, that needs a lot more investment. What we haven't seen yet is more support in terms of getting more projects permitted. And I think that's the next piece that governments need to work on. So, and obviously there's programs like the IRA and in Europe, I think it's the Critical Minerals Act or something like that. So more countries are going to have to do, and Australia does some, but doesn't have a program as sort of wide. I think every country will need to have some sort of that if they want to sort of help, because the cost, if you compare the costs, that those benefits, so some sort of tax incentives and tax credits for consumers buying EVs, that all sort of pushes the equation a little bit to get it more balanced in comparison to other sources. But we do need to see faster permitting periods, like waiting for a decade, 2 decades, 3 decades for a mine to get permitted is just ridiculous, and we're not gonna get the minerals that we need with that.
I want to pick up on one of the comments you made in your opening statements about Albemarle and their failed attempt at Liontown. So Albemarle came out not too long ago increasing their forecast or demand by 2030 up to 3.7 million metric tons of LCE. And of course, the Liontown play was an attempt to service some of that feedstock deficits that they have. And that's a direct result, and they stated that's a result of the IRA incentives that's present in the States and in countries where they have cooperation with. So what that means is they're going to be sweeping up all the tier 1 jurisdictions, all the countries that deal openly and got free trade agreements with the US. But that doesn't take away the demand and the requirements that's still existing in China. So what that means is probably less favorable jurisdictions are going to have to come into play, and more expensive, higher cost production has to come online. And for any market dynamic, you look at the incentive pricing on the cost curve, that's what's going to determine the bottom of your price index. So I think the IRA influence is certainly going to increase the supply that's going to come online, but it's also going to open up opportunities to less favorable jurisdictions and also lower grade products. That means you're going to push up the price as a result of that higher cost base.
I mean, how is this going to impact, like, we have this regionalization of supply chains happening right now. In one of our recent events, someone was saying, you're essentially creating parallel supply chains globally for essentially stuff that's could potentially already be there. So, how is that impacting the space, this regionalization trend, duplicate supply chains, all of that?
I think, just going back to Paola's points previously and your question, I think that the whole supply chain is becoming very geopolitical. We've seen a big shift in kind of the geopolitical angle in the last year, as Europe, as the US, as China basically ensure that strategically they're well placed to take advantage of this and kind of hit their net zero goals as well. and then you kind of go down a layer into the OEMs and some of the midstream players who are positioning themselves in their own country or in particular other countries, and how that fits within the policies that are being announced, such as the IRA. We've seen a lot of shift in South Korea, as I said, but we've also seen a lot of Chinese investment in the US, which there's a bit of uncertainty about kind of where that will fit and if those projects will ever actually get off the ground, because they may just be rejected by the IRA. But yeah, that geopolitical angle is very important. So it's not, it's coming from those governments really. But the regionalization theme I kind of sense has backed off a little bit. We're starting to see supply chain shape for policy, but maybe less so on a kind of a local or regional basis. I don't know whether panelists feel the same. A couple of years ago when I was looking at these markets, there was a big shift as, we need to bring everything to the US or everything to Europe. And actually the policy announcements recently aren't really suggesting that entirely. There's a lot of incentive in the downstream to produce batteries and midstream processing in the US, but actually the IRA is supporting upstream in FTA countries and other partners. So that's not really onshoring the upstream, and Europe's the same. They don't have a great resource base for a lot of the critical raw materials, so they're going to have to rely on other countries, but they're then going to incentivize the processing in the downstream. So I think that kind of regionalization, localization thematic maybe has eased a little bit, but at the same time I think the policy angle has accelerated rapidly, and we're seeing it as being fundamental to the way in which supply chains are mapped out.
I think I agree with you, Harry, in that I'm not seeing it so much as a localization, but as a desire for diversification of sourcing. So in Europe, they've stated that quite explicitly, that no more than 60% of a supply of certain products should come from a single country. And so I think the US is doing the same thing. They want that broader security in terms of supply. And the place that we have the biggest challenge in this value chain is in the midstream, that is so heavily weighted towards China in precursor and CAM and anode active materials. And the tricky thing about that is how do you build supply elsewhere that is inevitably going to be higher cost when we're not necessarily seeing those incentives flow that far back through the supply chain, I don't think just yet. Sort of commodity markets like having that sort of market price, and those buying commodities like to not think that they're paying over the odds. Maybe they will on a capital basis, but not necessarily for product just yet. So I think solving that problem is a tricky one.
I was gonna just comment that how can you avoid China? Like, it's so significant that if you say, that's why I think it was Yellen, they're talking about the coupling, how do we say it in a way that recognizes that if we steer away, we're in deep trouble. It just doesn't work. So just managing that relationship, I think, and with everything happening in the world right now, it's just so difficult that you have to sort of put the geopolitical things to the side and think, okay, I need to still work with them. It's like that friend that you kind of don't like that much, but you still need to, meet with them because of whatever. And I think that part is, we've seen more supply and more capacity built elsewhere over the last 5 years, but it's still not moving the needle much. So over the next little bit, I think more needs to be done, but also you still need to work with it. It's just, I was gonna mention as well, one thing that we did see was that the Tesla refinery in Texas, that was 1 billion. You say, oh, 1 billion, they're investing 1 billion and they're benefiting from the IRA. But it's just one refinery. How many more would be needed? Like, is that enough for the U.S., what the U.S. needs?
To the point of sort of friendshoring or decentralization, I don't think is a result of policy. I think it's done out of necessity. It is for security of supply. So the end users are going to the source. And as a result, that creates this single stream supply chains. There's not a very successful LME-like style market for lithium metal at the moment. So you do not have a choice but to go to the source. And as a result of that, you are, in essence, decentralizing the entire supply chain.
That's a good point. It's a vertical integration and also a security of supply. I'll just be quick on this because haven't got much time, but back in the early last decade, if you were an investment banker, you were in charge of, say, mining or the coal industry, and you did all the coal M&A deals and all the coal IPO deals. And there'd be the energy guy, and he'd be the power guy, or the power stations, and he'd be in charge. And there were different silos, right? And then you got the transport guy that would focus on transport, and the health guy. And what happened was all of a sudden, power companies were buying downstream or upstream into coal mines, and it never happened before. So you'd get KEPCO, for example, a Korean electric power company. Traditionally, they would just buy the coal. They would actually take a 10% stake in an Indonesian coal mine. And Enel, the electricity company of Italy, would also buy a 15% stake in some coal mine around the world. And I thought that was quite interesting because there was a cross-industry approach, and I'm seeing that now, and it's what you brought up, is since when ever would you have heard someone like Mercedes want to buy 10% stake in a lithium mine? I mean, this kind of stuff is incredible. It opens up so many opportunities from a funding point of view, from a business point of view. So now you've got the Chinese car manufacturer for Great Wall. They were one of the first many years ago. They bought, I think, 2 or 3% stake in Pilbara Minerals. So you get car companies buying stakes in lithium mines. You get Tesla has done a deal now with BHP for their nickel. This is kind of unheard of. So it's created a lot of opportunities, but also it's a vertical integration. And back to your point, it's kind of a necessity thing. It's a security of supply. So companies are scared. If you're a car manufacturer, all of a sudden you need so much more raw materials, and you don't want to rely on a third party to bring it to you. So you're actually now investing in that commodity, which is an amazing concept. And I've only seen it once before, which was the coal industry back in the early 2010s when people actually thought they were running out of coal. So all of a sudden there were a lot of people were buying that. What happens eventually is those companies like Mercedes that invested X% in a lithium mine, they've secured supply, and then it reaches an equilibrium, and at some point they'll divest it again, because they know they've got the relationship there on that. So it's good from an M&A point of view, but it's very interesting, that dynamic where you got Volkswagen too. They've set up their own separate entity called PowerCo, and they're buying. PowerCo is actually out looking actively for lithium and nickel projects globally.
Yeah, all the major automakers have done some sort of deal, and it's even flowed down to copper explorers. So Stellantis, who, it's a former Peugeot and Fiat, they actually bought, I can't remember the percentage right now, but it's about either 14 or something like that, of a copper explorer that was a client years ago, McEwen Copper. And I've actually been to that project, to the Azules projects in the Argentinian Andes. And we've never seen that. Offtakes, yeah, we saw that a while ago, but now there are more. But even seeing them put a risk capital in explorers or near developed, it's amazing.
Yeah, and by the way, Mercedes is looking to hire a geologist as well, so never would have thought I'd said that. And the earlier speaker actually on uranium said that Bill Gates was looking to buy a nuclear expert or hire a nuclear expert. So the world's gone crazy.
Any closing thoughts from our panelists before we wrap it up? Okay. Well, you guys made my job really easy today. I have a list of questions that we didn't get through, but I want to thank our panelists for joining us here today to talk all about batteries.